how big a deal or how much of a headache is this for Mario Draghi? He was hoping inflation would pick up, and it's just not, especially core inflation.
No, this is a really significant issue, and there are two clear drivers of which he has no real control. The first is the export of inflation or deflation from North Asia. There have been signs of a pickup in export inflation. That's now reversed. The other side, of course, is the strength of the euro. When one looks at Adidas's results as an example, they were great in anything other than the euro, but the strength of the euro makes it very difficult for companies to make progress, and therefore, by extension, inflation is low.
We're also following James Pierre Moscovici. He is the European Commissioner, of course, in charge of monetary affairs, delivering the spring economic forecast. He says that inflation should increase slowly in Europe, so we'll monitor that very closely. But James, talk to me about, Jean-Claude Trichet did a huge mistake about 10 years ago because the market were pricing, and he had to reverse an interest rate hike. How does the market actually interpret a kind of withdrawal of stimulus, or how does the ECB have to communicate that to the markets without suggesting an interest rate hike? Would that be badly taken by the markets?
I think the European Central Bank has a very material challenge. Mr. Draghi is a master, however, of communicating with the markets and persuading them to interpret what he is saying the best possible way. So if anyone can do it, he can. But the scale of the challenge, both in terms of the absence of inflation, the low level of real growth, and the stresses within the European system, as evidenced by the imbalances within the target to cash interchange, is very real.
James, you're perfect to talk about this. Here's the money question today. It links into Fed Day. It links into Jobs Day as well. Europe's got its own calculus and clearly has some form of ebbing rate of inflation growth. Is that transferable over to the United States, or is that discrete to Europe?
I think Europe's problems relate to a fundamental lack of, first of all, integration at an economic level, which means that parts of Europe remain deeply uncompetitive. They have suffered extreme unit wage cost inflation on an internal basis, but they have no mechanism to adjust the policy agenda. So we have one interest rate that just doesn't apply to all European economies, and we can't have a shift in the relative exchange rate. So those fault lines in Europe remain. America, in contrast, has always managed to send more money around the States. About 4 times as much money can transfer within the States compared with in Europe because of the nature of the EU.